Let's talk about your financial dreams. You just need the right tools and strategies. High-yield investments are like the express lane to your financial goals. They offer the potential for higher returns compared to traditional investments. Higher returns often come with higher risks. That's why it's crucial to understand what you're investing in. Knowledge is power, especially when it comes to your money. We'll explore different types of investments, discuss their risks and benefits, and provide you with practical advice for getting started. Remember, investing is not about getting rich quick. It's about making smart choices today to secure your financial future. Before we dive into the specifics of REITs and MLPs, let's address a crucial aspect of investing: risk tolerance. Not all investments are created equal, and each carries a different level of risk. Risk tolerance refers to your ability to stomach potential fluctuations in the value of your investments. Some people are comfortable with a higher level of risk, especially if it means the potential for higher returns. Others prefer a more conservative approach, prioritizing the safety of their principal investment. Understanding your risk tolerance is essential before making any investment decisions. Assess your comfort level with risk before diving into any investment. Once you understand your risk tolerance, you can choose investments that align with your financial goals. The important thing is to invest in a way that allows you to sleep soundly at night. Now that we've covered the importance of risk tolerance, let's dive into the exciting world of REITs. Diving into REITs, real estate made easy. Let's talk about real estate. Owning a skyscraper might seem like a distant dream, but what if you could own a tiny piece of it? That's the beauty of real estate investment trusts, or REITs. These investment vehicles allow you to invest in real estate without the hassle of being a landlord. REITs pool money from investors to purchase and manage income-producing real estate properties. By investing in a REIT, you become a shareholder, owning a piece of the pie. Let's paint a picture of REITs in action. Imagine a company called Sunshine Retirement Homes REIT. They own and operate a chain of senior living communities across the country. As an investor in Sunshine REIT, you're essentially becoming a part owner of these communities. You're investing in the buildings, the land, and the potential for rental income. As more seniors seek comfortable and convenient living arrangements, the demand for senior living communities rises. This translates to higher dividends for you, the shareholder. REITs offer a way to diversify your portfolio beyond traditional stocks and bonds. Just like there are different types of houses, there are different types of REITs, each catering to a specific segment of the real estate market. Equity REITs own and operate income-producing real estate, like shopping malls, office buildings, and apartment complexes. Mortgage REITs finance real estate projects by providing mortgages to borrowers. Hybrid REITs combine elements of both equity and mortgage REITs. Specialized REITs focus on niche sectors of the real estate market, such as healthcare facilities, data centers, or self-storage units. They cater to investors seeking exposure to specific industries. With such a diverse range of REIT options available, you can choose investments that align with your financial goals and risk tolerance. Think of them as the specialists of the REIT world. Why are REITs so appealing to investors? Let's count the ways. REITs offer the potential for attractive dividends. They're required to distribute at least 90% of their taxable income to shareholders. REITs provide an easy and accessible way to invest in real estate. You can invest in a diversified portfolio of properties with a relatively small investment. REITs are highly liquid compared to traditional real estate investments. You can buy and sell REIT shares on major stock exchanges just like stocks. REITs offer the potential for long-term growth. While REITs offer a compelling investment opportunity, it's essential to understand the risks involved. One of the primary risks associated with REITs is their sensitivity to interest rate fluctuations. REITs can be affected by economic downturns. REITs are subject to market volatility. By understanding these risks and incorporating REITs as part of a well-diversified portfolio, investors can potentially mitigate their exposure. Now let's move on to another exciting avenue for high-yield investments: Master Limited Partnerships, or MLPs. MLPs might sound complicated, but they're really about tapping into the backbone of the American economy: energy. Think pipelines transporting oil and gas, storage facilities for natural resources, and even renewable energy projects like wind farms. MLPs offer a way to invest in these essential infrastructure projects and potentially reap the rewards. MLPs are publicly traded partnerships that own and operate energy infrastructure assets. They generate income by charging fees for the transportation, storage, and processing of natural resources. Now let's unpack what makes MLPs unique. Unlike traditional corporations, MLPs are structured as partnerships. This means that instead of owning shares of stock, investors own units in the partnership. One of the key benefits of the partnership structure is the potential for tax advantages. MLPs are considered pass-through entities, meaning that the partnership itself doesn't pay corporate income taxes. Instead, the tax liability is passed through to the individual partners, or unit holders, based on their ownership percentage. This can result in lower overall tax burdens for investors. When most people think of MLPs, they think of oil and gas pipelines crisscrossing the country. And while it's true that a significant portion of MLPs operate in the traditional energy sector, the MLP landscape is evolving. Today you can find MLPs involved in a variety of industries, including natural gas pipelines, crude oil pipelines, storage facilities, processing plants, and renewable energy projects. This diversification within the MLP space provides investors with more options to align their investments with their values and financial goals. Whether you're seeking exposure to traditional energy sources or looking to invest in the future of clean energy, there's likely an MLP out there that fits your investment criteria. MLPs offer a way to diversify your portfolio beyond traditional stocks and bonds. Like any investment, MLPs come with their own set of potential rewards and risks. MLPs offer the potential for high distributions and growth. The partnership structure of MLPs can result in lower overall tax burdens for investors. However, MLP prices can be volatile, especially in the short term. MLPs operating in the traditional energy sector are particularly sensitive to fluctuations in oil and gas prices. The K-1 forms associated with MLPs can be more complex than traditional 1099 forms. MLPs can be a valuable addition to a well-diversified portfolio, offering the potential for high income and growth. However, it's essential to approach MLP investing strategically, carefully considering your risk tolerance, investment goals, and overall financial situation. Start by determining if MLPs align with your investment objectives. Next, consider the role MLPs would play in your overall portfolio. Finally, do your homework. Research different MLPs, understand their business models, analyze their financials, and assess their growth potential. We've journeyed through the exciting worlds of REITs and MLPs, uncovering their unique characteristics and potential for generating those high-yield returns you're after. Now let's bring them face to face for a comparison. It's like choosing between two delicious desserts. Both can satisfy your sweet tooth, but one might tickle your fancy just a tad more depending on your preferences. REITs, our real estate champions, offer a way to tap into the stability and growth potential of physical properties. They're like owning a brick-and-mortar piece of the American dream, from sprawling shopping malls to cozy apartment complexes. MLPs, on the other hand, provide a gateway to the energy sector, with a focus on the infrastructure that keeps our nation powered up. Think of them as the behind-the-scenes heroes. ensuring the smooth flow of oil, gas, and even renewable energy sources. Both REITs and MLPs come with that enticing high-yield allure, often distributing a significant portion of their cash flow to investors like you and me. But remember, every rose has its thorns, and both investment types carry their own set of risks and considerations. Let's explore REITs and MLPs to find your high-yield match. REITs pros: tangible assets, diversification, and liquidity. Cons: interest rate sensitivity, economic cyclicality, and taxation. MLPs pros: high distributions, tax advantages, and growth potential. Cons: volatility, energy price dependence, and tax complexity. Section 3, REITs, MLPs, or both, building a diversified, high-yield portfolio. Now for the million-dollar question, REITs, MLPs, or a bit of both? The answer, as with most things in personal finance, depends on your individual circumstances, risk tolerance, and investment goals. If you're seeking exposure to the tangible world of real estate, appreciate the potential for diversification within the sector, and prioritize liquidity, then REITs might be your cup of tea. They offer a way to participate in the real estate market without the hassle of being a landlord, providing a steady stream of income from rental payments. On the other hand, if you're drawn to the high-yield potential of energy infrastructure, comfortable with a bit more volatility, and seeking potential tax advantages, then MLPs could be your golden ticket. They offer a way to invest in the backbone of the energy sector, benefiting from the transportation, storage, and processing of essential resources. But here's the beauty of it all. You don't necessarily have to choose. Just like you wouldn't limit yourself to just one type of food, your investment portfolio can benefit from a diverse menu of asset classes. Consider incorporating both REITs and MLPs as part of a well-rounded investment strategy. Think of them as complementary pieces of the puzzle, each contributing to your overall financial well-being. By diversifying across different asset classes, you can potentially mitigate risk and enhance returns. Section 4. Your high-yield journey. Taking the next step towards financial freedom. As we conclude our exploration of REITs and MLPs, remember that knowledge is power. You're now armed with valuable insights into these high-yield investment vehicles, empowering you to make informed decisions for your financial future. Take the time to assess your individual needs, risk tolerance, and investment goals. Consider seeking guidance from a financial advisor to create a personalized plan that aligns with your aspirations. Remember, investing is a journey, not a sprint. It's about making smart choices today to secure a brighter tomorrow. So, take that first step, explore the possibilities, and embrace the potential of high-yield investing to unlock your financial dreams. Section 1. Beyond REITs and MLPs. Expanding your high-yield horizons. We've spent some quality time with REITs and MLPs, those high-yield heroes in the real estate and energy sectors. But the world of income-generating investments doesn't stop there. Think of REITs and MLPs as just two slices of a delicious, multi-layered cake. Each slice offers its own unique flavor, but there's a whole cake to savor. Just like you wouldn't limit yourself to just one type of investment, it's wise to explore the full menu of options available. Diversifying your portfolio across different asset classes is like having a financial rainbow. It's not just prettier to look at, it's also more resilient and adaptable to market storms. So, let's broaden our horizons and explore other avenues for adding some high-yield oomph to your portfolio, shall we? We'll venture into the world of dividend-paying stocks, uncover the potential of bonds, and even touch upon alternative investments like business development companies and closed-end funds. Now let's talk stocks, but not just any stocks. We're talking about those generous companies that like to share their profits with their shareholders. That's right, we're talking dividend stocks. Think of it as becoming a part owner in a company and receiving a piece of the pie as they grow and prosper. Dividend stocks represent companies that have a track record of consistent profitability and a shareholder-friendly approach. Instead of hoarding all the earnings, they distribute a portion of those profits back to their investors in the form of dividends, usually paid out quarterly. It's like receiving a thank you check from the companies you believe in. Now, not all companies pay dividends. Some prefer to reinvest all their earnings back into the business for growth, while others might not have the financial capacity to share the wealth just yet. But for income-oriented investors, dividend stocks can be a compelling addition to a portfolio. They offer the potential for both income generation and capital appreciation, a win-win scenario. Imagine owning shares in a well-established consumer goods company that has been paying dividends consistently for decades. Not only do you benefit from those regular dividend checks, but as the company continues to innovate and expand its market share, the value of your shares could also appreciate over time. It's like having your cake and eating it too. However, it's essential to remember that not all dividend stocks are created equal. Some companies might offer higher dividend yields, but their payout sustainability could be a concern. Let's shift gears from the stock market and explore another avenue for high-yield returns bonds. Bonds are IOUs issued by governments, corporations, or municipalities when they need to borrow money. Investing in bonds means lending money in exchange for interest payments and principal at maturity. Bonds are less risky than stocks, offering fixed income and priority in financial distress. However, bond prices fluctuate with interest rates. High-yield bonds or junk bonds offer higher interest but come with greater credit risk. They are issued by companies with lower credit ratings. For those comfortable with more risk, high-yield bonds can enhance a diversified portfolio. Congratulations, you've now expanded your high-yield horizons beyond REITs and MLPs. But with this knowledge comes responsibility. Think of yourself as an explorer venturing into uncharted territory. Here are some tips to help you stay on course. Diversification is key. Don't limit yourself to one type of investment. Spread your risk across different asset classes. Diversification is your financial safety net. Understand your risk tolerance. Assess your comfort level with potential fluctuations. Do your homework, research different companies and industries. Knowledge is power, especially with your money. Consider professional guidance if you're unsure. A financial advisor can help create a personalized plan. Asking for help is a sign of strength. Stay informed about market trends and economic conditions. The investment landscape is constantly evolving. We've explored the exciting world of high-yield investments, uncovering the potential of REITs, MLPs, dividend stocks, bonds, and more. But now it's time to roll up our sleeves and create a roadmap for your own high-yield journey. Think of it as planning a cross-country road trip. You wouldn't just hop in the car and start driving without a destination in mind, or a map to guide you, right? The same principle applies to investing. A well-defined plan will serve as your trusty compass, helping you stay focused, motivated, and on track to reach your financial destination. So, where do we begin? First and foremost, identify your financial goals. What are you saving and investing for? Is it a comfortable retirement, a down payment on your dream home, or perhaps funding your child's education? Having clear financial goals will provide direction and purpose to your investment decisions. Next, determine your time horizon. How long do you plan to invest your money before needing to access it? This is crucial for determining your risk tolerance and choosing investments that align with your timeline. If you're investing for a long-term goal like retirement, you have more time to ride out market fluctuations and can consider investments with higher growth potential. However, if you're investing for a short-term goal like a down payment on a house, you'll need to prioritize capital preservation and choose investments with lower volatility. Now that you have a clear understanding of your financial goals and time horizon, let's talk about risk. Remember, every investment carries some level of risk, and high-yield investments typically come with a higher risk-reward profile. Think of it as a seesaw. The higher the potential reward, the higher the potential risk, and vice versa. The key is to find your sweet spot, the level of risk you're comfortable with, to achieve your financial goals. Start by assessing your risk tolerance. How comfortable are you with the idea of your investments fluctuating in value? Are you okay with riding out market downturns in pursuit of long-term growth? Or do you prefer investments that offer more stability and predictability? There's no right or wrong answer when it comes to risk tolerance. It's a personal decision that should be based on your financial situation, investment goals, and emotional comfort level. Once you have a good understanding of your risk tolerance, you can start choosing investments that align with your profile. If you're more risk-averse, you might consider a larger allocation to lower-risk investments like bonds or dividend-paying stocks from well-established companies. If you're comfortable with more volatility, you could explore a higher allocation to growth-oriented investments like stocks or high-yield bonds. You've set your financial goals, determined your risk tolerance, and you're eager to start building your high-yield portfolio. But before you dive headfirst into the investment pool, remember that you don't have to go it alone. Just like assembling a winning sports team, building a successful investment strategy often requires the expertise and guidance of experienced professionals. Think of it this way: if you needed surgery, you wouldn't try to operate on yourself, would you? You'd seek the expertise of a skilled surgeon. The same principle applies to managing your finances. Financial advisors, like skilled surgeons, possess the knowledge, experience, and specialized tools to help you navigate the complexities of investing and create a personalized plan that aligns with your unique needs. A qualified financial advisor can help you define your financial goals. They'll work with you to understand your aspirations, whether it's retiring early, buying your dream home, or securing your children's education. Assess your risk tolerance. They'll guide you through a series of questions to determine your comfort level with investment risk and create a portfolio that aligns with your profile. Develop an investment strategy. They'll help you choose investments that are appropriate for your goals, time horizon, and risk tolerance, ensuring your portfolio is well diversified across different asset classes. Monitor your portfolio. They'll regularly review your portfolio's performance, make adjustments as needed, and keep you informed about market trends and economic conditions. Congratulations! You've charted your course, assessed your risk tolerance, assembled your financial dream team, and you're well on your way to building a portfolio that generates those high-yield returns you've been dreaming of. But remember, investing is a marathon, not a sprint. It's about making consistent contributions, staying disciplined, and riding out the inevitable market ups and downs with patience and fortitude. Think of it as sailing a ship across a vast ocean. There will be calm seas and stormy weather, but with a sturdy vessel, a skilled crew, and a clear destination in mind, you'll weather the storms and reach your desired port. Stay focused on your goals, automate your investments, and resist the urge to time the market. Review your portfolio regularly to ensure alignment with your goals. Remember, the journey to financial freedom is a marathon, not a sprint. Embrace the journey, stay the course, and watch as your high-yield investments pave the way to a brighter financial future. We've covered a lot of ground on this journey to unlock wealth through high-yield investments. Remember those dreams we talked about? That early retirement, the vacation home, the peace of mind? They're not just fantasies, they're possibilities waiting to be unlocked. We've explored the dynamic worlds of REITs and MLPs, those high-yield heroes in the real estate and energy sectors. We've ventured into the realm of dividend-paying stocks, those generous companies that like to share their profits. We've even uncovered the potential of bonds, lending our way to high-yield returns. And remember those essential tips for navigating the high-yield landscape? Diversification, understanding your risk tolerance, doing your homework, seeking expert guidance. These are your tools for success. The most important step? It's believing in yourself and your ability to achieve financial freedom. It's about taking control of your financial future and making your money work as hard as you do. So go ahead, take that first step, and unlock the financial powerhouse within you. Start building that brighter future today.